Okay, good evening once more, and welcome to this today's class.
Yes,
Hello.
yes, sorry.
Okay, so we'll start now. I'm sorry for the few distraction. The person that was supposed to help me manage the class is currently not available, so I had to do that as well. Yeah, so we'll just pick up from where we left off the last time. We'll complete the ratio analysis. I think we stopped somewhere around here, after which we dive into introduction to financial statements, preparation or presentation. So that's basically what we'll be doing today. So for the ratio, we'd only look at one question, right? We'll look at it together and work it out together. Um, I'm not sending like a different sheet or workbook for the solution. We are basically using the Pathfinder since it's ratio analysis. So we'll do that for the publish. That one is very important. But for the ratio, we'll just walk through it with your explanation. Now we are fine. So yeah, let's confirm we can see my screen by use of emoji, and let's also confirm we can hear me very clearly. You Udo, your hand is raised. Do you have any concern or any problem, any question? Okay, so I'm going to go ahead and mute everyone's mic. If at any point in time you want to say anything, kindly indicate by raise of hand, and I would allow you to speak. I would unmute you so you can speak. Yeah, so that's to ensure that the class is well controlled. So I'm going to go ahead and let me admit these last people in, and we will just start. So we'll not keep them waiting. Admit. Yeah, so let's continue from where we stopped. I think the last time we looked at this we stopped here. We stopped here. This was where we're having arguments as to plus or minus. Yeah, I remember that vividly. So just as I mentioned earlier, and as I've always explained, when it comes to calculate what you get, the most important thing is for you to get the basic concepts, right? It's not just about how you do plus and minus, it's about how you are able to interpret those plus and minus. And as I mentioned before, when it comes to ratio, you don't have to cram anything. You don't have to cram the interpretation. You don't have to cram anything. All you just need to do is to understand those elements that makes up the ratio you're calculating, right? And that would help you to structure your answer more correctly. Take for example, this average time collection now. The formula says what trade receivables and credit sales. So what it means is that the only thing that can lead to an increase or decrease in this average collection period is either an increase or decrease in the trade receivable, or increase or decrease in sales. So once you make your calculation, you now be able to link it to those values that you were presented with. So as we move on to the Pathfinder, you would understand it better. You would understand it better. Let me admit, I think I see a few people that want to join. Let me admit them so we can continue. Others can join us via the YouTube link. So we do not distract the class. Yeah. Okay. So that's it. Let's move on. So now these are working capital efficiency ratio, right? So they are actually the ratios currently, and this is the purpose of the working capital ratio. So this purpose now is what will now help you to know to calculate, because some questions are actually silent as to which ratio precisely they want you to calculate. So, but by the time you understand what each ratio represents and you relate it to the way they paint their scenario and all, that will now inform you as to the ratios that the examiner or the people in that scenario are actually looking at or would be interested in. So working capital ratio measures the efficiency with which the entity has managed its receivable, inventory, and trade payable. And these things are the elements of working capital. So you're just trying to look at how effective and efficiently an organization has been able to manage their receivable, their inventory, and trade payable. So that is what the working capital ratio basically looks at, right? So if they are painting a scenario now, and probably the way they structure it now is looking like someone really wants to know how um how fast an organization, or probably the management, just want to know the flow of their working capital or the efficiency of that working capital. Now from there um you would know that this is what they want, right? So but don't worry, as we dive into the question, you understand it um very much. So they say the working capital ratio are useful measure of whether the entity has too much or little invested in working capital. So this one also helps with your working capital management, right? For you to know whether you have invested too much in your working capital, or um you have invested little in your working capital. So that's why they now went ahead to, highlight what excessive investment working capital is and what under investment in working capital means. So they say excessive investment in working capital is indicated by long cash cycle, right? A long cash cycle, which means a long working capital cycle that appears to be getting even longer. When too much is invested in working capital, the return on capital employed and return on shareholders' capital will be lower than they should be, right? So once, for example, in the previous year, your working capital cycle is actually not as long as the one for this year, or you compare your cycle over some years, you see that the cycle is getting longer and longer, then that is an indication that you have invested so much or too much in your working capital, right? And whenever this occurs, your capital employed would always be lower than they ought to be. Now, on the other hand, the when there is under investment in working capital, they said this is indication of possible liquidity difficulty. When working capital is lower in comparison with industry average, this might indicate that Current assets are being financed to an excessive extent by current liability, particularly trade payable and overdrafts, right? So when you find yourself in this situation, then you would know that you have invested in your working capital. And what will this result to? It will result to what? Liquidity difficulty, right? Liquidity difficulty. Why? Because your current asset is being financed basically by what? Your current liability. That means if those people that are owing you does not pay, you would not be able to finance your business, right? Or you will not be able to carry on your business. Or if you do not get like an overdraft from the bank, you would not really have much cash to carry on your operation. That is just basically that is basically what this means. So now these are the main ratios under this category. Let me check whether there is anyone waiting to be admitted so that I can admit them. Um, give me a minute, please. 7%. Meet all. Okay, I think we are good now. Yeah, so let's continue. Yes, um, the different ratios that I'll be looking at under this heading, right? The first one is the average time collection, right? Average time collection. That is like the receivable. When you are talking about collection, you're talking about receivable. Like, how long will it take you to receive cash from those that are owing you? That's just basically what this one is looking at. How long will it take you, right, to receive your cash from those that are owing you? You sold on credit. How long will it take you for those customers you sold to on credit to pay you back? So that's basically what the average time to collect or receivable collection period ratio is looking at, right? Let's say trade receivable should be the average value of receivable during the year. So this is in situation where you are giving opening and closing, right? Opening and closing. In that case, you can use the average receivable. That means where you have this trade is receivable at the top here, what you use is the average. But under normal questions, the one I've seen, you are only giving just one or trade receivable that you can just use, right? So they actually mentioned that, however, the value for receivable at the end is commonly used. So that is them giving you the liberty to use either. You can use either the average or the closing at the end of the year. Now, in most question scenario, you might not be given a credit sales, right? So whenever you are being given a sale on the face of your income statement and they didn't make any other comment as to whether those sales are credit sales or not, the sales you're going to bring in here would be that sales you have there, regardless of whether there was an indication as to whether the sales was on credit or not. That is just what you are going to bring in here, right? So that is simply what they are explaining in this place. They say sales are usually taken as total sales for the year. However, if sales are analyzed into credit and cash sales, it is probably more appropriate to use the figure for credit sales only. That is, for example, sales, they say sales is 200,000. They now went under additional information to say that part of that 200,000 sales, 150 sales was on credit while 50 was on cash. So if you're coming to calculate your trade receivable period for you to get a result that is more accurate, you use that 150,000, which is the credit sales part of the transaction. So that is just that about that. Now the next one is average time to hold inventory, just as the name implies, right? Or they can call it inventory turnover period. It's just simply you trying to calculate how long it will take you to hold that inventory that you have before you sell it, right? You buy goods for sale. You're just trying to like look at, okay, based on previous performance, or based on this um purchase that we have made, how long are we expected to hold this inventory before we sell it? That is just basically what you are calculating with this ratio, right? I mean, getting the information as to how long a particular inventory is expected to stay in stock before you sell them out or you turn them into sales would help you to plan yourself well towards restocking, to avoid running out of stock. That's just basically what this one is looking at. And the formula is what? Inventory all over cost of sales. So whether your average inventory period for a particular period increase as against the one for the previous period, right? It will be dependent in the increase or decrease, or dependent on each of these factors, right? So that is that. What did they say here? In theory, inventory should be average value. Yeah, it is the same thing. Of all the calculation, when you are giving opening and closing, you can just use the average, but don't confuse yourself. You can just pick the closing balance and use like that to avoid mistake, so that you not overdo. Yeah. So the next thing is average time to pay supplier. Just the name, as the name implies, you're just trying to look at how long it will take you to pay your suppliers, those people that you bought from on credit. How long will it take you to pay them back? That's just simply what you are looking at. So just as we mentioned earlier, this is just working capital, right? You are looking at how long it will take you to get the money that people are owing you. You are looking at, okay, this inventory self that I'm holding, that I bought on credit, let's just put it like that. The inventory I bought on credit, how long will it take me to turn them into cash so that I would be able to what, pay those that I'm owing? Or how long am I able to get cash from those that are owing me so that I'll be able to also pay those that I'm owing? So that is just how all these working capital ratios are interconnected, right? So that is just basically it. Let's move forward. Let me check if there's anyone to admit. Yeah, there's someone to admit. So let me quickly admit them.
Please, your screen is not showing again. After admitting them, you can share again, please.
Yes, I'll go back to the screen now. I'll go back to that place. Yeah, so we are back. So this is the working example that they gave us. I'm not going to go through this because we already have a question that I want to look at, so we'll not waste more time here. Yeah, so this one is turnover. So the above ratios that we just look at 5 days, which means that your answer is always in days. Your answer is always in days, right? So that. I just wanted to mention that. Yeah. The say turnover ratio can be used as an alternative way of telling the same story as efficiency ratio. This shows the number of times a balance in the statement is turned over in a period, right? So when you hear turnover is usually in time, to say how many times can I turn this thing into cash, or how many times can I get this. That's just basically what the turnover ratios are about. You have receivable turnover, right? Receivable turnover, inventory turnover, and your payable turnover, right? So that is just, you're just basically looking at the number of times that you're able to turn over each of these elements. So that is just it. So let's move forward. Yeah, so this is cash operating cycle or working capital cycle. The cash operating cycle or working capital cycle is the average time of one cycle of business operation from the time that supplier are paid for the resources they supply to the time that cash is received from customer for goods and services that the entity makes or provide with those resources then sell, right? So this capital working capital cycle or cash operating cycle is just like the summary of the entire working capital ratio that we just did, right? So, and how do you calculate it? Your average inventory holding period is the first thing that you're going to bring down, right? Then your average trade receivable collection period, right? You add both together. So, um, you add both together, right? Then you now subtract average periods of credit taken from supplier. So if you look at the flow of this thing very well, this is how it flows. You're just trying to look at, okay, oh, average inventory holding period. This one is now showing you how long you are going to hold that inventory that you purchased before you turn it into sales. And what does your sales result to? It results. And you're also looking at, okay, oh, let's assume that you did not even sell all this inventory in cash, right? The ones I sold on credit, Unko, how long does it to receive cash from those people I sold to on credit in order for me to do what? Pay those that I'm owing. So that is just basically what this working capital cycle is looking at. That is just the summary of it, right? So that gives you what? The operating cycle for you to see how your operating cycle works. So they say the working capital ratio and the length should be monitored over time. The cycle should not be allowed to become unreasonably in length with a risk of over or under investment in capital. So it is this cycle now that you now use to check whether you have over or under invested in working capital. Yeah. So that just that about that. So let's move forward. Let me check. Okay. Is there anyone? Okay. Can we all hear me? Let's confirm we can hear me with our emo because I can see some complaint now that they cannot hear me. Okay. If Unaya is it, yeah, for those that were not in our last class, I would forward the link for the previous class after this class so that you guys can actually go back to it and check what we did in the previous class. So I'll do that. If Naya, sorry, it's probably I going to go out and join back. Victor Moses, do you have any questions? I can see your hands. Please go ahead. Do you have any question?
And it's some Victor. Um, I want to ask, how are we like you were when you were reading out for the operating cash cycle? You didn't tell us how to get our average those variables there. Like you didn't mention it.
Mention it. That is what I've been explaining from the beginning of the class. Actually, those are those different this thing.
Like
See,
this one, like the average inventory holding period. I didn't.
this is it now. This is what we have been looking at. This is it. Inventory days is still the same thing as inventory holding period. and this
Okay,
is your
okay.
receivable. Yeah, so those are those things. You just this one is just like the summary of everything.
Okay.
I hope that answers your question. All right, thank you. Um, let me see who else. Okay. Jamil Babatunde, you can go ahead.
Oh, good evening.
Good evening.
Okay, sorry, I just want to understand one thing, a clarification.
Mm-hmm.
Is it the stock turnover, is it the same thing as inventory holding days?
No, no, no. The turnover is different. Turnover, you're looking at the number of times that you can
Okay,
actually,
that's
yes. But the days, you're looking
oh,
at the times in terms of days.
okay. Because I have a formula for it. I don't know if it is correct. Inventory, the stock turnover is cost of sales over average stock. Is it correct?
I
Stock
don't know.
turnover you're
I
talking
just want
about.
to,
You're just trying to
Okay,
look at
okay,
how many times you'll be able to turn those, how do I even explain it? To sell those stock you're holding. Or how
okay.
it just is
Okay.
usually once you hear turnover, it's usually in times.
Okay, times. Okay.
Yes.
Thank you, man. Why the inventory times is
In days, you are
the
looking at
inventory over cost of sales.
Mhm.
I just want to understand the formula for the inventory.
Okay, let me go back to that place so that you can see it.
Okay, thank you, man. Thank you. Okay. Oh, okay. Thank you. I've seen it. Thank you.
please, ma. I think you are muted. Please.
Oh my God. So all the explanation I've been doing since, so is it just now?
It's not just now.
That's
You
about.
can't be. We have not been hearing you.
Sorry. So, but if we got the explanation I did with over and under investment, Abby?
No, no, please,
No.
can you
Ma,
take
we
the
stopped
door?
at when you showed
We stop at the inventory part
inventory.
when the
Yes.
last guy asked
No problem,
question.
no problem. I would just go over it briefly. Oh God. I don't talk plenty things, so okay. Let me quickly just run over it. So I saw a question in the chat box asking how they would be able to understand or calculate the over or under investment. So the answer I gave is that before they will ask you to either text you on this under or over investment in working capital, definitely they will provide you with information to say that, okay, the working capital cycle in the previous year, or working capital, or should we say average industry average, industry standard working capital cycle is this so number of days, right? Then you will now calculate your own cash cycle or working capital cycle using this formula. So whatever you have here as your operating cycle is now what you would now compare with the information you were providing, you were provided with, right? To know whether, okay, let's say at the end of this place, let's say we have 5, or let's say we have 20 days as our operating cycle, and the inventory average, the industry average operating cycle that we were provided with was actually 50, right, as the standard operating cycle. Then in that case, we can conclude that we are under invested in working capital or something like that. So that is just how it works. So these are how you calculate it, and you always have something to compare it with. But if you do not have anything to compare it with, you can decide to just work it out like this and just let it be, because there is no much to say about that. So that's that about that. Let me check. Okay, let me go ahead. So that's that about that. We're not looking at this. You can look at it at your leisure time. If you have any questions, you can draw me back to that. So let's move forward. So now we are looking at liquidity ratio. Liquidity, from the name, you know what they are saying. When we talk about liquidity, we are talking about ability to turn something into cash, or ability of an organization to have cash to meet with their needs. So that's just basically what it means, right? But here, they say liquidity means having cash or access to cash readily available to meet obligations. Yeah, so that is just what I explained just now, right? They say the purpose for ratio analysis or liquidity on the assumption that the only source of cash available are cash in the bank and current assets that will soon be converted into cash, right? So wait, let me go over this again. For the purpose of ratio analysis, liquidity is measured on the assumption that the only source of cash available are cash in the bank, right, plus the current assets. Okay, yeah. So that means when it comes to liquidity with regards ratio, they just assume that these are the only two sources of cash that an organization has. Okay, they say it is also assumed that the only immediate payment obligation faced by the entity are its current liability. So what I just mean saying here is that the liquidity ratio deals with your current assets and current liability. Let's just put it like that. I mean, specifically your cash and your other current assets. So they say, okay, it is also assumed that the only immediate payments obligation, okay, is your current liability. I've mentioned this one. So they say there are two ratios for measuring liquidity. The first one is what? Your current ratio, and the second one is quick ratio, also called acid test.
Can people just unmute their system, please?
I'm going to mute everyone now.
I think that would be better off, please. Thank you.
Yeah, I'll mute everyone. I even thought I did it earlier. I don't know why I still have people that are able to unmute. Unmuted. Why is it tripping? Okay, so I think everyone is muted at this point. I don't know why it's tripping. Either is going back. So let's just ensure we keep our mic muted so that we'll not waste time. I've muted everyone now. Before I know it would. So let's just try and cooperate, please.
It's not working. Let's move on.
Yes. Let's move on. We have a lot to cover tonight. So yeah, so this shows that that are under the liquidity, the current ratio, and the quick ratio. So when we talk about the current ratio, you're just looking at your current assets, right? All over your current liability. So they say the current ratio is the ratio of current asset and current liability. You're just looking at those current one, those short-term um asset and liability. Let me just put it like that. That's just what you are trying to look at. They say the amount of current asset and current liability in the statement of financial position at the end of the year is what you are going to use. So if the financial statement that was given to you or the SOFP is such that all those sections have already been added together, just go to where you have the total of your current assets and pick it from there, and go to where you have the total of your current liability and just pick the figure. But if the template or the format used does not present it that way, then you might have to add everything yourself manually to get your calculation. Yeah, so they say it is sometimes suggested that there is an ideal current ratio of 2.0 times or 2.1. So if you're having something that is either less or above that, let me check, then you know that there is problem. They say, however, this is not necessary to, or in some industry, much lower current ratio are normal. It is important to assess the liquidity ratio by considering changes in the ratio over time, liquidity ratio of other companies. So what they are saying is whatever you have, whether what you have is actually below this 2:1 or above it, right? Below it particularly, I think that's the main challenge. If it's below it, then you have to compare. Also, you also need to consider the changes over time and also compare it with the ratio of other companies within that same period to know if it's like a general industry thing, right? So that's just basically what they are saying. But ideally, it should be within this way. So if what you calculated is 2:1, it is fine. If there's anything above it, I think it's still fine. So that's just basically what they are saying. Yeah. So and you have to monitor it over time in order for you to ensure that you are following up with your liquidity position. So that's just basically what they are saying here. And they say liquidity should be monitored by looking at the changes over time, current assets in excluding current liability. No, I think that's okay. Yeah, so that one is this one. Let's not miss it. So the quick ratio, now the difference between the quick ratio and the current ratio is the fact that quick ratio is just trying to look at your liquidity position. If your inventory, the inventory you are holding in your hand is excluded, right? You're also trying to look at, okay, what is the cash that will be available to us if we are not to consider those inventory at hand, because we don't know when we would convert that into cash. So that is just what that quick or acid test ratio is just looking at, right? And yeah, so what I just said now is what they are explaining here. They said inventory is excluded from current asset on the assumption that it is not a very liquid. You don't know when or how soon you would be able to convert those inventory into actual cash. So that is why the acid test ratio excludes inventory in its calculation, right? So don't mind all this one that they are saying here. Okay, so they say it is suggested that there is an ideal quick ratio of 1:0 or 1:1, right? However, this is not necessarily true in some industry, much lower. So that means if you have anything that is low below this, then you know there is a problem. But regardless, you still have to check if the inventory the industry average is usually below this 1.1. For example, if they say the inventory average for the quick ratio is 0.5, right, and you got something within that range, then you would not have to panic or say that no, it's below the ideal whatever. So that is just basically what they are saying here. So you have to consider all those tiny, tiny things. Yeah, liquidity ratio and consolidated accounts. Let's read what they have to tell us there. The liquidity ratio are more informative when they are calculated for individual companies. When liquidity ratio are calculated from a consolidated statement, they are average measure for all companies in the group. The average liquidity ratio for the group might hide the fact that there may be poor liquidity in some subsidiaries. So that is just what they are saying. Simply put, for a group company, they say that it makes more sense for you to calculate liquidity ratio for group A and group B separately, so that you would be able to clearly see the liquidity position of each of the subsidiary. Because if you should use the consolidated figure to calculate the liquidity ratio, what you would have is like the average, right? And that would not help you to see the actual liquidity position of each of the individual subsidiaries. So that's just basically what they are saying here. So let's move forward. We have solvency/debt ratio. Solvency/debt ratio. Let me see. Is there anyone waiting for me here? I think I have two people. Let's bring them on board and continue. Okay.
Which one? This just released a few of them.
Mr. Olopade, can you please help us mute your mic, or are you talking to me? Thank you. Yeah, so let's go on. So this is solvency/debt ratio. Ratio are used to assess whether the total debts the entity are within the control or and are not excessive. So you are just trying to see that, okay, what's the level of our debts, right? You're just trying to see the level of our debt, to see how much we are owing people, to see if we are financing our operation excessively through debt or other means of financing our operation. So that is just basically what this debt or solvency ratio is looking at. And under this, we have different ratios that we'll look at. So the very first one is the gearing ratio, right? Gearing ratio is also called leverage, measures the total long-term debt of a company as a percentage of either the equity of the company or total capital. So what they are saying is, what is our total debt? You measure it against your equity to see that, to measure the level of debt, right? Either you are just measuring through only your equity, or you are trying to compare it against your entire capital, right, including equity. So those are the two different ways that you can calculate the gearing ratio. So the first one is debt to equity ratio, right? Debt to equity ratio. What this one is trying to look at is, okay, what is the ratio of your debt to your equity, right? What percentage of your finance is through debt or from debt, and what percentage of it is financed by equity? That is just what it's trying to look at, right? Just as the name implies, debt to what? Equity ratio. That's basically what you are trying to calculate, and the answer is always in percentage. Abi? That's just what you're trying to look. And they say alternatively, just as they mentioned earlier, you can use your total debt, right? Plus your share capital and other long-term debts, right? Your reserve, in fact, your total capital is what you are comparing it to. So you can use either of these to calculate your gearing ratio, depend on what you really want to achieve. Yeah. Okay, so this one is still that old story as whether you can use average or the closing rate or closing value provided, but it is advised just use your value at the end of the year. They say when there are preference shares, it is usual to include the previous shares within the debt capital. So that is just that, so that when you see preference shares, you not say, okay, oh, it's only share capital, reserve, and this thing. So whatever is just part of your capital structure is what you're adding to it. Yeah. So a company is said to be highly geared or highly leveraged when its debt capital exceeds its share capital and reserve. This means that a company is highly geared when the gearing ratio is above either 50 or 100, right? Depending on which method is used. So what I'm just saying is this 50-50. Now, once you get 50 on the dot, it means that, okay, your capital structure consists of 50% debt and 50% what is it called? 50% debt and 50% equity. But in situation whereby the results we are getting now, we are having something like 70. So what it means is that 70-30. That means your debt percentage in the capital structure is 70%, while 30% of your capital structure is equity, right? That means you are highly geared, right? You are highly financed by debt rather than equity. So that is just basically what this whole English is about. But when you are lowly geared, when you have a gearing ratio that is below 50, let's say we calculated it and we are having something like 30, right? So what it means is that we are more financed by equity by 70%, while the debt part of our capital structure is 30%. And what does that mean? That means the company still have more opportunity to access to access more loan or finance in order to expand. So that is just what it actually means. So when you are that's a lowly geared, right? So it's more like you having more opportunity or more access to fund. Then on the other hand, if you're highly geared, it means you have to look at other ways of financing your business rather than debt, right? Because if at any point in time you can't get any other money from any source, then you have sort of exhausted your you have over financed yourself through debt, right? Because getting more money or getting more loan now would affect what your profitability ratio. How? Because your net profit will be reduced as a result of increase in what your finance cost, because the more loan you take, the more interest you would be paying. So that is how you link all these things together when it comes to ratio interpretation. I hope that is clear. Yeah, so I think this is what I explained now that they are still breaking down here. Let's just quickly read through it. They say the entity has a high level of debt, which means that it might be difficult for the entity to borrow more when it needs to raise new capital. So this is just what I explained. So that means when your company is highly geared, these are like disadvantage of you being highly geared, right? When you need that urgent money, you are not able to. It's more like saying you have exhausted almost all ways that you can get like urgent loan or more debts from. So when you are lowly geared, it's just the opposite of you saying that, okay, I'm lowly geared. That means now if the need arise, I can always run to this social bank or run to this social source to get more debt capital. So that is just basically it. Then highly geared can indicate risks that the entity will be unable to meet its payment obligations to lenders when those obligations are due for payment. So it's still the same thing here, right? when those obligations are due, because you are financed by debt, right? You would not have like enough, you can't get like any extra money when the urgent need arise to meet up with those obligations. So that is just basically, I've explained it already. I'm just trying to like, they are still saying the same thing here. So gearing and consolidated accounts. So let's see what they have to say here. The gearing for group is difficult to interpret because the debts will be spread over several entities in the group. When measuring gearing, the total capital equity, the denominator in the ratio should include minority, right? Should include your NCI. So that is just what they are saying. So what they are basically saying here is that this place where you have your total capital structure here, you should include the NCI as part of it. That's just what they are saying. So that's that about that. Let's move forward. The next ratio we'll be looking at is what's your interest cover ratio. Yeah, interest cover ratio measures the ability of a company to meet its obligation to pay interest. You're trying to look at, okay, oh yes, we are financed by debt, we have a loan we are servicing. You're not trying to look at your ability to meet up with the payment of those interests as and when due. So that's just basically what interest cover is looking at, and this is the formula: your profit before interest and tax all over your interest charge for the year. So interest that you are expected to pay by the year is what you are now trying to measure or compare against the profit that you have, to see if that profit is sufficient enough to cover what the interest that you are expected to pay at the end of the year. Yeah, profit before interest and tax is calculated by adding the interest charge for the year to the figure of profit before tax. Yeah, so this one is just in case the P or L that you were given does not clearly state your profit before interest and tax. So if it's not clearly stated, you have finance costs. All you just need to do is your profit before tax, you add back that interest, that finance cost part of it back to it, in order for you to take your profit back to what? Profit before interest and tax. So that's just what they are saying here. Yeah, so I don't know what they are saying. So let's just look at. There's a note that what constitutes low or high gearing very much depend on the type of company, right? So what I'm just saying is it depends on the type of company, it depends on the industry structure, right? So they say, for example, company with high level of physical assets are able to borrow more because they can offer assets to secure lender. So what they are saying is companies that have more assets, right? Because you have a lot of assets and you can use those assets as collateral, regardless of whether you are highly geared or not. So far you have those things that you can use as collateral to get more funds. You would be able to still access more funds. So that is just what they are saying. Then they say company with low physical assets might be expected to have lower level of borrowing because they cannot offer assets as security. So it's just like the opposite of the first one, right? So for this first company, whether they are highly geared by 70 to 30%, they have a lot of physical assets that are of value, that are substantial value, that they can use as collaterals, right, to get small funds. But if on the other hand, a company is such that does not really have much physical asset, then you don't really have much to fall back on. No one is going to answer you. So they just indicated this just in case, so you would know. So they are trying to calculate gearing ratio here. You can always look at that. Then investors ratio. This one is looking at, okay, I want to invest in company. What are those things? So a scenario can be painted that you are considering investing in either this or this without them actually telling you the actual ratio they want you to calculate. So it's not left for you to say, okay, if I'm the investor and I want to invest in a company, what are those things that I would most likely be interested in knowing. The very first thing that you want to know is the profitability. How profitable is this company? You also want to look at the liquidity ratio, right? To know if this company are able to meet up with probably dividends or other obligation, right? For you to know the going concern of the company. Then you also want to look at this investor ratio to see what the earning per share or what the return rate is from the investment that you want to make. So that just let me check. Hope I'm not muted. Okay. So let's move on. Let me check the chat box. Yes, we'll do the calculation now. We'll go to the calculation now. I'm just trying to explain how you're able to link those things. Okay. The equation I want to solve covers everything, so that's why I just want to like walk us through it. Hope we are still together. Let's use our emoji. Let me be sure that people have not slept and left to leave me here. Okay. Thank you very much. So these are investors ratio. Investors ratio are interest to investors, right? They are of interest to investors, just as I explained earlier. Those that want to invest would want to check, right, what the earning per share is, what the price earning ratio is, right, and what those other dividend yield ratio. So those are like the basic ratio that investors want to know, especially this earning per share, price earning ratio, and I think dividend yields. These three key ones are the ones that they want to look at. So EPS is just simply looking at, okay, what is the earning that you are going to gain, like the return you gain, your earning per share, right? So, and the way to get it is to measure the total earning for the year, which is the net profit, right, over the weighted average of number of shares. For example, the number of shares you have with the company is what you are now comparing it with to know how much you'll be earning by each share that you owe in the company, right? And the price earning ratio is comparing the market value of the share against the EPS that you've calculated earlier for you to know the how do I ever explain this one now? Okay, let's just take it from here. They said it measures how expensive or cheap a share is in relation to its annual earning, right? To its annual earning. So what you're just trying to compare is what's the market value per share and what is your own earning per share for you to know whether your earning per share is actually okay or not. So that's just basically what you are looking at there. And dividend yield is just comparing your dividend per share all over the current market price per share, right? All over the current market price per share for you to know whether that dividend that you're getting actually has more value when compared to the market price. So I think that's that. Okay, so let's move forward. So I think the other thing that you need to take note of and take seriously when it comes to ratio is just about you cramming that formula. So the first one is the formula. Second one is how you are able to link your answer to the scenario, right? To the scenario. So then you ensure to read the limitations of ratio, right? The limitation, they usually ask this question at times. So read it very well, just know it so that if it comes out, it will be like a bonus 4 or 5 marks to you. So then you look at these other limitations. Yeah, other limitations. Then This one is another topic. Yeah, there's another topic. I think I saw this question today. Oh, I'll call you back. Okay. So that's that. Let's go to the question, right? So let's just go through the remaining part of it. If you have any question, you can always you can always reach out. You can always reach. That 2 mark is very important too. If you have 48, maybe it's 2 mark that will make you cross to 50. Every actually. So that is why we try to get as more free mark as possible. Yeah, so let's move on to the question I want us to look at. No, this is not it. I think this is it. This is the question. So what I did was I opened the question on this side and the solution on this side so that we can look at them side by side. Yeah, so we can look at them side by side. So this is how ratio questions comes, right?
If we can't see your screen again, please.
Can any other person see my screen?
Is your network? We can see your screen.
Is your network?
We can see your
All right,
screen.
No, we can see it too. I can see it.
It's
I can
okay.
see it.
Yeah, so it's actually your network. You might want to log out and come back. Yeah, it will be better.
Please, which here is the question, ma? Which here is the question?
I'll
Please.
scroll it up so you see it now. The question is question 2, May 2025. Happy? Yes. May 2025. Question 2, May 2025. Yeah, let's confirm it. But that is it. May 2025 question 2. So that is it. So this is how your ratio question comes in, right?
Sorry,
They'll
ma.
give you your.
Sorry, ma, please.
Yeah, go ahead.
Yeah, please. Will you send this to the platform, ma, please?
The question.
Yeah, on the screen.
Okay, no problem. I'll do that.
Thank you very much. God bless.
Yeah. Just give me a minute. Let me attend to something. Thank you. Sorry for the break. I had to quickly attend to something. So yeah, there are 2 questions that comes in this form. Your ratio and your cash flow question. So when you see question that they give you your income statement like this and your SOFP, it can either be ratio or cash flow question. But in this case, it is ratio question. So the question can come directly like this, where they give you this question like this and ask you to calculate something, or it starts with a scenario that they build up, right? Then they'll bring this in and ask you to calculate, and they'll not even ask you to calculate anything. So that is just how it is. So anyone that has all those different scenarios, they might not ask you to calculate anything. Just from the scenario now, you will now be the one to use your head now to know what you are expected to calculate. I don't know if we can get one question like that so that we can just see it. But this is the one that I'm using. Let's check if there is any question that has such scenario. So we'll see how you are able to determine which ratio to calculate, right? So I think I saw one where they were trying to invest in either one to acquire one business or the other. Yeah, one business or the other. So they didn't tell us which ratio they want us to calculate. So from there now you now be able to know that, okay, of all the ratio, anytime they ask you to calculate ratio, the very first one, profitability is always part of it, right? Profitability is always part of it. Then every other thing follows. But that profitability, you do it first. So that is that. So they gave us the income statement here. So now here is the logic about ratio and what helps you with your interpretation. As you have calculated your ratio now, you're not going to look at all this value, right? For example, if probably our profit ratio reduce this year compared to this year now, what could be the reason? From the value now, you can tell, yes, although our sales increase in this year, Abi, compared to this year, but what happened at the same time? Cost of sales doubled, Abi, triple self. And so whatever difference we are having here, we can now link it to the increase in cost of sales. We can link it to the increase in the selling expenses and all these things. So you compare the figures as well. It will now help you to develop and present your interpretation better. Right? You can see that regardless of the increase in revenue, look at the margin of increase between revenue, right? Look at the profit. It's just a little. The profit here is just higher by just little margin, right? So those are the things that you can consider. So then I now give you your asset as well. So those line items, you look at them, the changes in the figure, right, and the formula in the ratio you are calculating. That will help you to interpret your ratio very well. So now let's read what. Who is that? Is someone joining? Or is there a question in the group? Okay. Let me quickly admit these people. Because I want us to enter that publish this night. In the days we are meeting, we are solving one question on it and we are done. One long question like this. One long question on it and we are done with our. So my most likely meet during the week. Yeah. So this is it. So let's read the scenario. They said the director of Odots Venture Nigeria Limited appointed a new sales manager during the year 2024. The manager introduced a new sales policy to increase sales and profits by means of reduction in selling price and extended credit terms to the company's customers. So that means he extended credit terms. That means he starts selling on credit, let's just put it that way, to customer in order to increase sales. So this led to considerable investments in new plants, right? In order for them to meet up with that sales increase, they had to invest more in plants and equipment. That means they bought more assets, right? To meet the increase in sales. Now, required, calculate the following profitability and liquidity ratio for year 2023 and 2024. Now, remember that we said ratio is actually not meaningful when you don't have anything to compare it with. Imagine they say calculate profitability ratio alone, you just calculate it and drop it. You can't interpret it now because you don't have anything to say, okay, there was an increase, there was a decrease in comparison with this or that. So that's why they're asking you to calculate. Some question might come that they will not ask you to calculate, but they've already provided you with the ratio for the previous year. Your own is calculate the ratio for this year and compare it with the one of the previous year. So, or they provide you with the industry average for all the ratios. Then you now calculate the ratio for this year and compare it against the industry average, right? But in this case, these are the ratios that we're asked to calculate for 2023 and 2024. So let's dive right into it. Number B, explain whether the financial performance and position of the company has improved for the year. So now you need to follow the question the way it is being asked. First one is what? Calculate. They did not say you should speak any English there. Calculate it, bring down your formula, calculate it, and just leave it to get your 6 mark. That's the first step. Calculate. So when you say you calculate and you are missing it with the explanation, it's more like you reducing mark for yourself, right? So calculate first. That is the first mark. The B now say what? Explain whether the financial performance and position of the company has improved for the year ended 31st 2024 as a result of the new policy. So you are comparing 2023 ratios that you calculated against 2024 on to see whether there's an improvement or not as a result of the new policy. So this is where your explanation and the linking of your ratio to the scenario as well as the figure on the face of the statement comes in. Then the next one is calculate the amount of cash which should be realized if the company would impose a debt collection period of 45 days. All revenue are on credit. So you see that they even mentioned here that all revenue are on credit. Sometimes the question will be silent. If they are silent, just assume that this revenue that we have on the face of the financial is just on credit. Just pick it. Don't even bother yourself. So yeah, so let's look at the solution now. Solution 1, just as I mentioned, calculate. That is what they say you should do, right? So I don't know, any method that works for you is what you are going to do. This is what I usually use when I was writing my exam. So I used to put them side by side, right? I used to put them, whichever method works for you best is what you are going to do. They ask you to calculate for 2 years. This is year 1. This is year 2. So the first one is what? Profitability ratio. This is your gross margin. So you just pick the gross profits, right, from your income statement, right? The gross profit here is what you are picking from your income statements all over your revenue, which is the revenue here. So this formula part is just straightforward. Cram your formula. Cram it now. Be cramming it from now so that you not feel overwhelmed. Depend on what works for you. Some people believe in that last period of cramming of formula. So any method that works for you is what you should stick to. But basically, the very first thing is know your formula. The interpretation part will be easier for you if you know your formula. And the formula does not have any confusion. It's just you saying this divide by this times this. So just division and multiplication. That is just everything about the formula. So remember we talk about current ratio, right? This one is 4.41 to ratio 1, right? It's just saying, let's just say it's 4.4 to ratio 1, and this one is 3 ratio 1, right? Okay, this is acid test. Remember we said this one should be 2 to ratio 1, right? 2 to ratio 1. So I think these ones are fine. So let's move to the interpretation part. Then I'll now show you how you are linking it. So now when we calculate our profit margin to say, okay, in 2024 our gross profit margin is 1%. Why in the previous year the gross profit margin is what? 60%. So the question you ask yourself now is, why was there decrease in gross profit margin? What led to the decrease in that gross profit margin, right? So to answer that question is, what are those things that you consider before you arrive at your revenue, right? Second one is what? Cost of sales. Now, let's look at our question. Was there change in the revenue and cost of sales? Yes. What happened? Revenue increased from the previous year. That one is understood. Then what's the second one? The cost of sales, which is like the main thing that is just there. Abi? Yes, the gross profit and the revenue. So now you can now link it to say, okay, oh, the decrease is as a result of increase in cost of sales, right? Because if your revenue is 40 and your cost of sales is higher, what it means is that your gross profit will be reduced. Let's assume that our cost of sales is like 10,000 now. That means the gross profit will be higher, will be around 30 something, right? Which means that our gross profit is higher. So the increase in cost of sales is what led to that reduction in gross profit margin when compared to the previous year. So look at the profits, the revenue in the previous year, and look at the cost of sales, right? Compare it, you see that the margin is actually a bit high. So that is why our gross profit reduced when compared to the previous year's one. So let's look at what they said here. They said in 2024, Odud Venture Limited implemented significant strategy changes under. So this one is more like you copying what they told you under that their scenario. You're just bringing it down first. That is you linking your answer to what the scenario you were giving before you now link it to the figures you have on the face of the financials, right? So significant strategy change under the new sales manager. They were the one that told you this one. You are throwing it back to them, including a low price, high volume approach, and extended credit. All these one, they are the things they gave you in the question. So you know how to creatively bring back those things to make your answer more sweet, right? Right? And more presentable. So this is just what they are doing. They are just rephrasing that thing they still gave us in the question. Now, these changes led to, okay, they told us that this person made changes. So now you're not telling them that this person made these changes in this so year. And these changes that this person made led to what? A remarkable increase in revenue from 14.4 billion in 2023 to about 44 billion. You can see that there is a remarkable increase. So now you're not even dealing with the ratio yet. You're comparing what I mentioned earlier, the figures, right? You are comparing the figures to say my revenue increased from. So there are two ways you can put it. Either you say increase from 14,400 to 44,800, or you say increase by. When you say increase by, you're only taking the margin, the difference, the increase, right? To say, okay, 14,400 minus 48. So by how much did my revenue increase? That is when you say increase by, right? But when you say increase from, you are saying this was what it was and this is what it is now. Let me confirm we are still together. Yeah, so are we still together? Okay, thank you very much. I wanted to confirm that. Let me be sure my network has not thrown me out. Okay, so let's continue. So that is what you are doing. So if there's anything I want you to note here, the very first thing is you're linking the question to the scenario. That was where they started from. This was the scenario they gave us. They brought that scenario out first, right? Before you now link it to what is really happening on the face of those financials. Before you now link it to what the ratio that you calculated, right? So that is just the flow of it. So regardless of the way they present that ratio question, you just approach it in that same manner and you would be able to present your solution very well. So they said your revenue increased from this to this, right, in 2024. However, that is just saying our revenue increased, but there is a but there. The company profitability weakened, right? Because you can't measure profitability just by revenue, because before you arrive at that profit, there are other things to consider, things like cost of sales, your operating expenses, right? So our profitability weakened, right? The gross profit margin it's reduced from 60% in 2023 to 40% in 2024, indicating reduced pricing power due to lower prices, right? Due to lower prices, you have reduced the price of your goods, right? You have reduced it, and you're still purchasing the goods be very high in comparison to the amount you are selling those goods. That is just what it means. So similarly, the net profit margin fell from 33% to 11%, suggesting of financing costs. So it's just like me telling you that you are considering the things that are in your formula, right? Gross profit. What makes up your gross profit is your revenue with your cost of sales. So if your cost of sales increase or reduce, it will lead to either an increase or decrease in your gross profit margin. When we talk of net profits, what are we looking at? Your gross profit minus your operating expenses. Increase or decrease in your net profit margin would be as a result of what? Increase or decrease in your operating expenses. You can't say that your net profits reduce and you not even look at the operating expenses. You are jumping to compare it with cost of sales. Sure, you get. So that's just how it follows, right? Suggesting a higher operating expense. If you even want to add more to it, you are not saying suggesting, you are looking at it now. Is it not right here? This is your operating expenses, Abby. This is your operating expenses. Operating expense. You can decide to add the total of all your operating expenses to say, okay, it's as a result of the increase in our operating expenses from this total amount in the previous year to this amount. Sure, you get that is you see adding more sugar to your answer. So that's how you go about it. I think there are people waiting to be admitted. Let me admit them so that we can move forward. There's no one here again. Okay. Let's continue. Okay. Please kindly share the question on group 5. I'll share the question after the class, so that I'll not be going back and forth. I'll share it.
Right?
Yeah, the solution is part of the question. Once you scroll up after each question, you see the solution at the end of the whole questions.
Okay, ma'am. Thank you.
So that's about that, right? So the second part of it is the other ratios that they ask you to calculate it. You can see that the answer is coming in the form that the question was. The first ratio we're asked to calculate is what? Your profitability ratio. So you explain that one first and you move to the other ratios that you were asked to calculate. So now we've been able to explain what? Gross profit and net profit. Now return on capital employed. When we're talking about return on capital employed, you are looking at what? Your profit before interest and tax. So increase or decrease in this ratio would be as a result of increase or decrease in your profit before interest and tax, and your profit before interest and tax is dependent on what? Other elements, right? Like your operating expenses and other things. So an increase or decrease in either of those elements would also result in an increase or decrease in your returns on capital employed. So let's see the explanation they give. They say 2, return on capital employed also declined significantly. They use the word significantly because look at the margin of decrease, right? You can decide to use it. So these words also matter. You can use significantly if the margin is much. You can use decline slightly, right? Depend on the margin of difference, or increase significantly or increased slightly if the margin is not much, showing that the company become less efficient in generating profit from the capital employed. This was largely due to increase in borrowing, right, from 1.6 billion to 25 point 25 point what 6 billion. So you can see the margin of increase between our borrowing. Where is it, sir? Where is it?
On that non-current liability.
So you can see the difference. So, and how does that affect your profit before interest and tax? It affects it in that if your borrowing increase, that means if you are paying 500 naira as interest on loan here, your interest on loan will jump to like 2,000, depend on the interest rate you are using, right? So let's look at the finance cost. If it's highlighted, look at the jump, right? Look at the jump here from 192 to about 3,000, right? So that is what is actually affecting. So the reason why this is what we are considering is because that profit is profit before interest and tax, right? Profit before interest and tax. So that is why it's like this. So your borrowing increased to this, which means that your finance cost would increase, right? So consequently, interest expense surged from, I didn't even see this one. So that is what led to what? The decrease in your return on capital employed. So that is how you link your answer, the question. So it's not only the ratio you calculated, you are comparing, you're also bringing in these figures just to make your answer more presentable and make it more professional. So bring in the figures where necessary, bring in the ratio when necessary, link it to the scenario where necessary. Look at where they link it to the scenario here. Used to finance asset expansion, right? So remember they said earlier that they bought more assets in order to meet up with the increase in sales. So that is what they brought in here. So for them to buy that asset, it means they had to borrow more money to get that asset. And that is the reason why their borrowing increased this much. So that is just how you do it. So link it, compare both ratio, link it to the scenario, and link it to what the figures that are on the face of the financial. So even if you not even remember anything, the figures alone can even earn you money. Just look at those figures. What are the changes? What changed between this place and this place, right? What changed between this place and this place? And that will help you to interpret your answers better. Okay. Yeah. So look at what they did here. Profit before interest and tax. But what were we giving on the face? We're giving profit before tax. How did they get profit before interest and tax? It's simply you adding back your interest income to your profit before tax, right? And that was what increased our profit before tax, right? Because that interest amount is actually high. So that is just basically it. So some questions will not give you these items outlined. It's just you using your brain. Profit before tax is what you are giving. And what we need is profit before interest and tax. So what it means is that this profit, you have to add back what? Your interest expenses in order to return this profit to what? Profit before interest and tax. I wanted to mention that. Yeah. So the next one is what? Okay, they say despite this, the company liquidity position improved, right? The liquidity position improved. The coverage ratio increased from 4 point this in the previous year to this amount. From this to this, indicating strong short-term solvency. However, the receivable collection period lengthened to 76 days. Which could delay cash inflow, right? And strain working capital, especially given the high level of trade receivable. So what they are just saying is that, based on what we calculated, our liquidity ratio is actually fine, right? Remember we said the liquidity ratio is usually compared against 2 to ratio 1. So now our own is now 3 point something, And when we compare it to the previous years, this is the one we have in 2023, and this is what we have in 2024. So what it means is that our liquidity position has even increased, right? But what you're now saying is that regardless of whether the liquidity position is improved or not, we still need to keep eye on our receivable. Why? Because our receivable collection period has increased. This is what it used to be before, and now it has increased to this. Why? Because the new finance sales manager is giving us more sales credits than before. Sure, you get. So that's why you see that our days is lengthening. So despite that, our current position is fine. Still need to keep eye on this receivable period and bring in place strategy to ensure that the receivable period is okay or reduced as much as possible. So that is just basically. So you can also add that to give yourself more mark. So those are the little things that makes your answer more unique and earn you more mark. Yeah. So the next one, they say in conclusion, why the new policy increase sales and improve liquidity, they compromise profitability. And profitability is usually the very, very first thing that every investor would want to consider when in determining whether to invest in a company or not, right? So, and introduce a financial risk through increase in debt, right? By increasing that debt, you are exposing yourself to how did I even used to call that risk? Financial risk basically, but there is one particular, I think, liquidity risk. Yeah, you're exposing yourself to that risk, right? So management must focus on improving margins, reducing debt, and tightening the credit control. So this is like the concluding thing. But the main thing that I want you guys to get here, regardless of how they structure the question, pay attention to the scenario one, because it is the understanding of the scenario, how you are able to link it to the ratio that you have calculated to say, okay, oh, this ratio that I calculated increase from this to this as a result of you pick something from that scenario they gave you. If there's anything reasonable, there is not all scenario that you can get something from, but one you can. As a result of this, you pick something from the scenario, and also as a result of this, look at the figures that you are giving. What increased, what decreased during the year? You can now bring that in as well. Before you now say, okay, it was a result of the above mentioned factors that led to the increase or decrease in this social ratio from this to this between this year and this year, or led to increase or decrease of this ratio, right? Sorry, whose mic is that? Please help us mute your mic. Oh. Who is that person? Yes, go ahead. Go ahead, find that.
Good evening, ma'am.
Good evening.
Please, I'm trying to get this capital employed. You said it is profit before interest and tax. So why are we now basing our answer to as a result of the how will I say it, the interest, the finance cost? Why are we basing our answer on finance cost? Please, the profit we are using is the one before interest and tax.
Yeah, so this is why we are basing it to it. Look at it this way. Your profit before tax is what? 4,000, Abby. So if the profits we now want to use to calculate the capital employed is your profit before interest and tax, that means if once we add this what is it called, interest to it, to this 4,000, our profit before interest and tax will be increased more than what is supposed to be, Abby. It will be increased. So that means it is what is it called? The increase or decrease in that interest that will determine that will affect the increase or decrease in your capital employed. I don't know if that explains it, Sha. Do you understand? We are comparing it with our capital employed. This is the capital that we are using to generate those income, right? And we're now trying to check that, okay, this is the profit from operation. The 4,000 is the profit from your operation after considering the interest, right? After considering the interest. So now, to calculate capital employed, we have to still add back that interest to see that, okay, how much return are we going to get from the capital that we use to generate that profit, right? If we are to consider our profit before interest and tax, how much are we still going to get from it, right? That is you considering all the costs or all the expenses, including interest. Or it's more like saying, okay, no, you're not considering it. You are considering your profits from operation. Let's just put it at that. Profits from operation. Yes, profit from operation. You have not considered tax, you have not considered interest. So that is why. Is it a bit clear now? Anyone? Who is that?
Now you can go on, ma, but I'm not. I don't get it, but you can go on, ma.
Okay. Just reach out to me later, so we don't dwell much on this. But just basically because you're adding back that interest to it. So if the interest is much, it means your profit before interest and tax will actually be higher, Abby, when compared to the capital employed or capital that is invested in earning that income, right? And the higher the interest, the lower the capital, the what is it called, return on capital employed. So that is just the best explanation I can give right now. So I think that's that about that. Or any see has like any addition to what I said. Okay, so in that case, let's move on. Let's move on. Check. If you have any contribution to it, just go ahead and drop it in us. I can just to help I understand better. Yeah. So I think that brings us to the end of ratio. Or do you have any question? What was that last question? So I'm coming. Yeah, calculate the amount of cash which would be realized if the company could impose, okay, a debt collection period of 45 days. Yeah, so let's see what they are doing here. So the debt collection period that we calculated now is 76 days with total receivable of 9 days. So let's see the receivable on the face of our account. Total receivable, where are you? Yeah, so these are total receivable. And the average days that it take us to collect that money that people are owing us based on our calculation was what, 76 days. So that's this, right? And they are now asking us that let's say if the collection period is reduced to 45 days, the new receivable figure will be what? 45 days over 76. So 45 days over 76 is saying that, okay, out of these 76 days that we have, we want to reduce, is only 45 we need out of it. Yeah, so let me just put it like that. So times the total receivable. So 5 million is the amount. They say the amount of cash that would be realized is now your 9 million minus this. So if you reduce your receivable period days to this is how much you are collecting or how much you are getting back. That's just basically what they are doing here. Yeah, so that brings us to the end. So this is the marking guard stating the current formula. So once you even state the formula, gongo, this is the mark you will get. Correct calculation of the gross margin. This is how much you get. So that means you get a mark for stating the formula and you get the mark for the calculation that you do for each of those ratios. So that is it. Then evaluation, analysis using ratio gross, using return on capital employed and everything. So these are the marks that you get for that interpretation that you did. So yeah, if you don't have any question, I'll say that brings us to the end of ratio analysis. That brings us to the end. Very low mark. Is that low mark that will make plenty mark now? That is why you get all the big mark. Yeah, so let's move on. So now we'll just go through the theory part of
Hello,
the
good evening, ma. Sorry, ma. Hello, sorry, ma. Sorry to disturb the class. I think there are some people that their mic are not unmuted. Maybe they should just unmute. You are distracting the class. If you know that your mic is on, kindly mute yourself so that we can enjoy this class. Thank you.
I don't know why this thing is mute. All are muted. Before you know it, will just go.
Hello, ma. Good evening.
Good evening. Yeah, I can hear you.
Ma. Yes, I get.
I don't know if you.
Yes, that's my observation. It's like it's from your background. Thank you.
Okay, I'm sorry about that. Sorry about that. So let's move on. So what I just want to basically do here today is to just walk us through the theory part of this financial statement preparation. I understand a lot of you are having concerns as to whether you'd be asked to prepare the financial statements with respect to IFRS 18 or IAS 1. So since the IFRS 18 is not yet in practice or it's not yet in application or they have not started applying it fully now, I doubt if they will ask you to do any calculation in line with have an idea about it. Those are the little things that can give you what is it called, extra marks. So maybe if you are explaining anything, you can just keep it in that. However, there's IFRS 18 now which says this or say in extra mark actually. So I just wanted to mention that. So we'll just quickly go through this, although these are things I expect you guys to be familiar with, considering the fact that this is skills level, but regardless, I'll still walk us through it, right? So that when we dive into the calculation, you would be able to follow better. Now, when it comes to publish, I want to state this even before I dive into the main thing. So when it comes to publish and solving questions with regards financial statement preparation, one thing is key. I think I have one question that I opened here. Let me check. Okay, yes. So you know that when it comes to financial statement preparation, being it anything that has to do with financial statement preparation, being it your consolidated account, there's what we call mass attack approach, right? It is that approach that enable you to gain as much maximum mark as possible without you even solving anything yet. Now, what do I mean? You have question, a very long question that has a lot of requirements. You pay attention to those requirements, not those items on those line items that needs that. If you see on this whole income statement, where did they make adjustments? Only cost of sales, your administrative expense, and what interest expense, which means that other item on this income statement does not need adjustment. And what does that tell you? It means you can prepare your accounts without even solving anything and you gain as much mark as possible. What's the very first thing? What's the name of the entity in question? Break it down. That one has given you small mark. The title, bring that one down, right? Your Naira sign. So this account is one account that can easily fetch you as much mark as possible without you even solving anything. Now, all these line item, if I'm not mistaken, to present all of them the way they are meant to like this, earns you some mark. So without even solving self, once you just drop your template like this, you gain a lot of mark. Same thing applies to your consolidated statements. It's not all the item on that consolidated that needs adjustment. So what me I even used to do, we want to use that mass attack approaches. The income statement, the way they give you, in fact, copy it down first. The heading, everything, drop it the way they give you. Then tick those items that need adjustment. For example, all those unrealized inventory, all those little adjustment, note them. The other ones that does not need adjustment, start putting in the figure, put in the figure, so that by the time your income statement, your SOFP template is already in place, the one that does not need adjustment already have the value there. You have gained as much as like 60% of the mark before you now go back to start solving all those adjustments. But the mistake that most people make is once you see question now, you focus, how do I solve this adjustment? To then from there now, you would waste more time, right? And it may be that at the end of the day, sir, this adjustment will not carry as much mark. Let's check the marking scheme so that you understand what I'm saying better. So we used to call that mass attack approach. So as the question is coming, drop it. But as you are dropping the template, you leave at some appropriate place that you need space. For example, after your advise that you leave at least 2 space there. Why? In case there will be other income. Sure you get. So that as you are looking at the additional information, if there is other income, you can easily bring that in between, right? So that is one thing. Secondly, avoid adding, because you don't know what you bring at the end of the day that will distort or make your work rough. So after gross profit, leave like 2 lines. If they are under income, bring it in. Then after the main profit, you can leave a line again as some. Same thing applies to your SO. You bring down the template as it is like this. You are not going to say, okay, profit this one. Leave like 2 lines because you don't know other asset that you might need to bring under your non-current asset. Same thing with your current assets and all that. So those are the things to take note of. So bringing down your template first has earned you as much mark, right? Even before you do any calculation. So first focus is what? The heading, which is the name of the entity, your heading, your Naira sign, bringing down your template, right? Then after you have done that, the next thing is look at those line items, check your additional information. If they did not say anything about investment, just know that, okay, the investment you were giving in your trial balance is what you are bringing here. It doesn't need adjustment. So you bring down all those things from your TB that you know that they do not need any adjustment. Look at this one now. All these shares is just coming from TB directly. It doesn't need any adjustment. How many adjustments did they make here? Only 3. So imagine that you brought down all these things. You have not even touched your additional information, yet you have gotten about 70 to 60% of your mark, if I'm not mistaken. So that's what we call mass attack approach. You get more mark by doing the very few things. Now look at the marking scheme. Correct title of the statement. That is you saying statement of financial position or statement of this. What does it give you? Is it watermark, Abi? So stating revenue, stating cost of sale. That means all these line items, for you to even state them, they are not talking about the calculation here too. Stating it, right? Stating it alone gives you this mark. Determination of cost of sale. This one carries 2 more mark. Why? Because it has an adjustment, right? Same thing with this admin and these other ones. So that is how you earn mark before you even dive into addition. Because once you dive into that additional information first, you might waste a lot of time there. Yeah, so I wanted to mention this before we dive in. So just take note of it. Once you get your question, be it group account or this one, group account is even easier. Group account is easier because already they've given you the template like that. That means you are not the one bringing down the template from your head. They gave you like that. Copy it the way they gave you. Just leave space at some strategic place that you might bring in probably an asset or other item later. But just make sure you bring the things down the way you are being given. So that is the very, very first step. I hope we are still together.
We are very much together. Wow. Jesus. So this
Madam,
is how we'll be
thank you for
missing Ma.
these tips. Thank you for these tips. In fact, I'm grateful for these tips. Thank you.
That is our mass attacker pro show. That is how I used to do it during the exam period, especially that group. As they are bringing it like that, just copy that template first. You have like even almost 80% mark, and you have not even done any adjustments. So, but
That's
just
why
be
the best is
careful.
the best.
Yes, yes. So just leave some space in between because sometimes from the additional information, it might require you to bring in maybe like a new asset,
Please, you can't
new
see
line
your screen
item.
again.
I've not gone back to that place. I'm not going back to that place. You see it once I get there. Yeah. So let's take note of our mass attack and get as much session is recorded. So after the class, you can always get what is it called? That link that I dropped for that YouTube is where you access the recording from. Once you click on it, you'll be able to watch the recording of the class. So yeah, let's go ahead. Let's go ahead. Want to join? Let me check. Okay. Who are you? Okay. So let's go ahead. People have started sleeping now. But we'll finish this theory. When next we are coming?
We're
We're
we are
much
here, ma.
awake, ma. We're not sleeping. We're
But
very much awake.
madam.
Yeah, go ahead.
So I want to ask you a question. You know, by saying that we should leave a space, won't they penalize or that the space is too much? Maybe at the end of the day you did not put anything there that maybe it makes your work not to be neat. I'm just asking.
Sorry, who is that?
Give me the phone.
I've muted the person.
Adegbola.
Mute your mic.
I have muted the person. So yeah, when we talk about living space, you do it very strategically. You're not living like 6 space because it's not possible for you to be bringing in like 6 different line items under one question. So the space you are living, either a line or 2 line at most. And if there is nothing there, you will not do it in a way that your work will be looking very far apart. For your income statement, for example, where is that question? Your income statement, for example, let me check. This is not Tito. This should be another one. Okay, yeah. Your income statement, for example, now. Let's just assume that the only thing that can come into your income statement is probably maybe they say they sold an asset. So that is like another income. And that usually comes after your gross profit. So that is why I always advise that after gross profit, add at least 2 lines in case there will be other income that you would have to bring in, right? So that is just it. For administrative expenses, this one usually have like a workings to it. So any adjustment that is coming into it is happening in that workings. You're not bringing it on the face of the account. Abi, the only one you're bringing is probably when there is other income that you want to show here. So the space you are supposed to leave here at most is like 2. One line is even okay. One line, because if you are saying other income now and the item you are bringing in is more than one, that means you have to open like another note for it. So under that your note now is where you write out all those other income, then the summary is what you are bringing here at just one line item. So one space is enough for this one. Then your non-current assets, right? So maybe you want to bring in investment, they made a new investment or something new, sha. So just one line is still okay. It's very fair. It's when you start living like 3 lines that your work will look for a pattern, look somehow awkward, then they will now complain about it. So we'll leave the stakes strategically. Yeah. So that's that about that. So let's just dive right in and walk through, not waste most time here because these are things that we're already familiar with. So we're just going to brush through it, right, very quickly. That's what we're just going to do. So the very first one is components of financial statements, right? So this is the very first session of this chapter. So this one is just looking at those different things that make up the financial statements, right? They said preparing the financial statement, the basic approach to preparation of financial statements and position, right, are as follow. The balance on all accounts. So this one is just them. Let me just make it simple. So now let's look at it from the practical side of it. When it comes to preparation of financial statement, what are you dealing with? Your what is it called? Let me come back here so that between you guys. What you are dealing with is your trial balance. So financial statement preparation has like a very should I say fixed flow, right? How things flow. So for your exam purpose, you are starting everything from TB. Nobody is going to ask you to say prepare TB. The TB is what you are being given, right, to prepare the accounts. But in practical sense, it flows from your journal. Let's say if you're using an ERP system, right? From there, you can generate your general ledger. It is the closing balance on each general ledger that makes up what your TB. And the TB now is what you are linking to what? Your note to the account and note to the account to what? The main financials. So that is the flow of it. Now, in exam situation, no one is going to say, okay, go and pass journal adjustments, do your general ledger, extract TB. That one is for foundation level. At this stage now, they are giving you the TB. So the published account is mostly focused on how well you are able to apply the different accounting standard, the different IFRS to the line item. Take, for example, now, your income statements. What are the standards that can be easily tested in your income statement? The very first one is what? IFRS 15. So if you are solving published accounts, they are not just going to throw one revenue for you and say, okay, use it like that. They might decide to just leave your revenue without adjustments. They might decide to test what? Your revenue IFRS 15 knowledge to say, okay, this was the revenue, just paint one rubbish scenario in your additional information one. So it is now your idea of IFRS 15 that you now be able to determine the correct amount of revenue to present on the face of what? Your income statement. What other standards can be tested under your income statement? Your IAS 2. Why? Because inventory is actually part of the things you use to determine your what is it called? Your cost of sales, right? So they want to see how well you would be able to apply that standard in a practical scenario. So the complicated part of it is you knowing your standards. So that is why at times they say solve as many questions as possible. This will help you to understand the different ways that this standard based scenario question would be brought into your exam, and you would also be able to understand how well to tackle it, right? So let's go back to that. So them say they are just trying to break down those things to say, okay, the balances are what makes up your trial balance. That's just basically what they are saying in this part of it. Now, the format of published accounts. Now, this is now the difference between IAS 1 and IFRS 18. So IAS 1 does not really give us that clear format to say, okay, this is how you must. It's not like a must, but they just give us like a principle or guideline that we can follow on how to present them. But IFRS 18 on the other side is saying that your income statement must have this subtotal. it must have this, it must have this. That's just like the major thin line or the major difference between your IAS 1 and your IFRS 18. So now, IFRS 18, that is IAS 1 now, set out those rules, right? Rules that you have to comply with that guides you on how to present your financial statement. So that is what your IAS 1 does. Now, they're now looking at what sets of financial statements. So what are those things, when they say financial statement, what are those things that come together to make a complete set of financial statement? The very first one is what? Your statement of financial position. It has to be there, right? Because that is what will give people an insight into your financial position as at that time. What is the asset you own as an organization? What is the liability that you own to other people? And what are those equity? What's the capital that you have to finance your business? So your SOFP shows what? Your financial position at the time. Which other thing is there? You have your income statement, right? Your comprehensive income statement, profit or loss, or anyone you want to call it. This one shows your financial performance. It shows how much you're making from your operation, that inflow, that profit. That is what your income statement shows. Then we have statements of changes in equity. This one basically shows the changes in those capital components of the company. What is the changes? Was there an increase? Was there an addition, right, from the opening balance for you to now have the closing balance that you would link to the equity side of your statement of financial position. Now, statement of cash flow, we treated this as a chapter on its own, right? It's just trying to focus on what? The cash inflow and outflow from the organization. How much cash, how much actual cash did you receive, and how much cash did you spend within that period? That is just what cash flow is showing. How much came in, how much went out, and how much is left with you as at the end of that period. So that is basically what your cash flow statement is looking at. Now, notes to the account. Notes to the account is an important element of financial statement. Why? Because this is what provides detailed explanation with regards each line item. Now, I come here and see what? Property, plant, and equipment. It's just one line item. And how did we arrive at this figure? Our note 4 is what's showing us how we arrive at it. Okay, let's go to note 4. What's happening in note 4? If I leave that question, okay, it should be, this is it now. Okay, I'm sorry. So what's happening in note 4? We'll look at our notes. Note 4, where are you? Now, note 4 is showing our PPE schedule. It's showing those different assets that makes up the PPE. So that is why the notes to the account is very, very important. Why? Because it breaks down each line item to show that, okay, equity and liability, these are the different items that makes up the equity and liability, right? So that is why you can see that when you're talking about the elements of financial statement, the notes to the account is part of it because it is an important part or component of the financial statement. Now, further requirements include financial statement should present fairly the financial position of the entity. Then comparative information. This comparative information now is you now showing the performance in the previous year, right, with what you have currently, so that people that are going through your financial statement will be able to see that, okay, what was our revenue for last year? It was this is the one for this year. So that is the importance of those comparative information of the preceding year. It helps you to understand the performance or the position of the organization over a period, let's just say 2 years minimum. So that is just that. Then each component of financial statement must properly identify with the following. Those are those things that I say we can use to earn our tiny mark. The name of the entity. When you are given the question, what's the name of the entity? Pick it and drop it first. It doesn't take anything from you, right? And what's the name of the account you are preparing? Statement of financial position. As at when you include the date there, that one will end you one tiny mark, right? What's the currency? So when it comes to currency, right, you pay attention to the currency in the question. And some question also used to tell you the type of precision to use, whether the figures are to be presented in thousands or in millions. And if it doesn't specify, you check your question. You can see that the question came in million. So if we check our question came in million, which means that any solution we are bringing in, we are still using this precision in million, right? So those are the little things to take note of as well. Then the rounding of figure, which is the precision I'm talking about, you have to take note of that as well. Okay. Yeah, so they say IAS 1 does not specify what statement must be called, right? Or allows the use of other terminology. So what they are saying is that you can decide that your statement of financial position, right? You can decide to call it balance sheet, no wahala. You can decide to call your own income statement as profit or loss, or you call it income statement, or you call it statements of comprehensive income. So IAS 1 does not specify or give you impose one particular name that this is the name you must use. So that is just basically what they are saying here. So yeah, general features of financial statement. These are the cocoa. These are the things that you have to bear in mind when presenting financial statements, right? They are like the basic principles that guide the preparation and presentation of financial statements. Now, this particular one can come as a question on its own. They can bring it as part of B, or just hide it somewhere to give you one tiny 2 mark or 4 mark. But whatever case it may be, just ensure you get that mark. Now, there's something I used to do whenever I have long list of things like this. It is my belief that it is better I'm able to catch 4 that I'll be able to explain very, very well in detail than try to pack everything at the same time and I'll end up not being able to answer any question. So for that reason, I used to try to give acronyms to some things, right? For this one, you can decide to pick like a very, like only 4 things that you can explain, like FAM now, FAM, to say fair financial presentation, you explain it, accrual basis is something you'll be able to explain very easily. Materiality, that is FAM. Yeah, explain that very well, right? And you can add your so depending on what works for you anyway. So, but just ensure you don't miss out on any free mark at all. So let's dive into each of those items. So when they say fair presentation is just simply, so that we will not look at all this explanation, it's just simply saying that the value you are presenting on the face of your financial statement, that is revenue, is that your actual revenue? How true is that figure, right? How true and fair is it? That's just what they are just looking at. So when we talk about fair presentation is looking at the relevance, the reliability of that information you are presenting. If you say your revenue is 50,000, is that 50,000 actually your revenue? That is fair presentation. You don't have to increase or to present a revenue that is not realistic. Doing so would be you acting contrary to the principle of what? Presentation. No. Yeah, so when you talk about fair presentation, you're simply talking about fair and true and fair, right? So make sure that every figure that you're presenting on your financial statement is not misleading. It is true, it is the actual figure, and you are not increasing any figure more than what it actually is. So that is just what representation is talking about. Then when we talk about going concern, just as we already know, is looking at an organization's ability to continue to operate into a foreseeable future, right? So when you relate it to financial statement, what they are saying is that you should prepare your financial statements, right, on a going concern basis, right, on a going concern basis, to see that you are presenting it in such a, you have it in mind that this organization will continue to operate, right? But if for any reason the company has going concern issue, or have reason to believe that their going concern position is no longer certain, right? Then in that case, the financial statement will be prepared, I think, on break-even basis, or something like that. Yeah, but other than that, your financial statement should be prepared on a going concern basis, right? And if you have any concerns with regards to your ability to continue business, then there is need for you to do what? Disclose that in your notes. Let me mute that person. Who is that? Okay, let's continue. So that is that about that. Then when we talk about accrual basis, just as the name implies, accrual basis, it means that every line item you are presenting on the face of the financial statement is not on cash basis. To say that you record a transaction when that transaction takes place, and not necessarily when you pay out cash or when you receive cash for the purpose of that transaction. So that is just simply what accrual basis is. So the income statement, the statement of financial position are all prepared on accrual basis, right? Except for cash flow, which deals with what? Cash. So, and that is why we have to make a lot of adjustments in the cash flow in order to remove that accrual effect or non-cash effect from each of those transactions. Why? Because we are looking at what? The actual cash that came into the business, or the actual cash that
I can't hear her.
Hello, we can't hear you again.
I hope our network hasn't gone off. Maybe I thought I was run off. I don't know.
I guess the network is what is affecting her.
Uze, mute yourself. Uze, mute yourself.
Please, I want to ask, is it item pack that she's using for us?
Yes, it
Yes.
is. I think it has even gone off entirely. Because we can't even see that Yusuf she's using to present.
Sorry, somebody responded that she's using icon pack. Is it this new icon pack or the old one? Old one.
No, previously the other one she has been using new.
I think
It's just
she's
this
using the two.
presentation that she used.
The old one and the new one. Thank you.
I don't think she's online again.
Sorry, can someone get in touch with her so that for us to know if we should still wait or we should call it a day?
You can as well do that.
I don't have a contact.
Maybe we should drop message in the group chat that she has logged herself out.
So does it mean that we should wait for her or we should call it a day? Because I don't understand that statement.
Let's just wait for some few minutes. Maybe laptop battery is off or something.
Okay, thank you.
Sorry, can you hear me now?
Yes. Can hear you.
My system suddenly trip and went off. I didn't realize that I've not plugged it since. So I've plugged it. So sorry for the break. And we might have to stop here for tonight. Yeah, we might have to stop here for tonight. I'll look for a free period during the week so that I would dive right into the question part of it and solve at least one question. Then we'll do the remaining one during our revision class so that I'll be able to touch on other topic. So the part I've taken so far, do you have any question on it?
Hello, madam. Thank you for today's class. Sorry, quickly one. I just want to a bit digress on the group account.
Mm-hmm.
On those line items, doing all those workings on the line on the face of the group account, is it allowed? Take for instance, under the non-current assets, like I have PPE now. By adding the PPE of the subsidiary and the parent together on the face of the book of the face of the account, is it acceptable?
Yes, it is acceptable.
Okay, thank you.
Just
Okay,
just
thank you.
put a bracket. Make sure that you need to that it doesn't flow into your main Naira line that you are putting the total.
Mhm. Is it the same thing on the
Mm.
POL? Can I do the same thing on POL?
Yes. Mm-hmm. You
Okay,
can do the same thing. Yes.
okay, okay, thank you.
Thank
Hello,
you.
madam. Thank you so much. More strength. Sorry, can you help
Thank
us
you.
resend the icon pack, please? Thank you.
Is it the pack or the question
The pack that you are
or
using now.
both? Okay, okay. I will resend the pack and I'll drop that question that I'm using as well. Then you guys can also go through this theory part of it. See if there's any part you're particularly having challenge on. When we come back, then we'll now look at that part specifically. So that when I come, we don't have to like go through all these things. The only thing we'll look at is the structure, the format, and pick any other thing that we have to pick with regards this line item, and we'll dive right into calculation. I hope that's
Thank you
fine.
very Thank you
Excuse
very
me.
much, Ma. I really appreciate your time and efforts. There's something I really dropped on the group chat and lot kind of things he has done with us. Will it be nice if
Mm-hmm.
you drop your own too? I don't know if you'll
Yes,
be.
yes. When I saw it, yes, I was going to do mine, but I'm kind of exhausted.
No, not today actually. Like I'm just saying, maybe during the week.
I'll send out the recording just the way like
Yes, thank you very much, and the notes too. Thank you.
Excuse
I'll
me,
drop the note.
please, for the purpose
Yeah.
of those of us that joined the class late, because someone like me now, I was not here when you did the group account and all of that. Please, I want to ask when the revision class, because something we do last year, we did a revision class that it was a special group that people paid and we go at it and we did revision about key topics. I want to ask when we will have that, like when exactly are we looking to start that revision class so that all the
We're
topics that have been
already working.
before we
We're
join.
already working towards we're already working towards the revision class. So the date will be communicated probably before the end of this coming week,
Okay,
us willing.
thank you.
Yeah, but meanwhile, before that, just to make it easier, because you can't just get everything in the revision, it
Yeah,
becomes easier for you to comprehend and follow more if you have gone through the previous class, right, before that revision time. So that will help as well.
thank you. Thank you very much,
So
ma'am.
once they drop the recording, I would you can also reach out to the lecturer, the one that took the consolidated part of it. I can reach out to him to also drop his own recording the same way as others, so that it'll be easier for you guys to navigate through it.
All right, thank you, ma'am.
Thank you, everyone. See you guys when we see. So if I'm able to get that free time during the week, I would communicate the time and dates in the group, and we'll meet with financial.
Okay. Thank you so much,
Bless you.
ma.
You
God bless you.
on.
All right.
Enjoy the
Nice,
remaining part
lovely
of the
week.
day. Yeah, you too.
Mhm.